3 legal strategies exist right now that let you move money out of your estate, reduce your inheritance tax bill, and in some cases pay zero. And HMRC wrote every single one of them into law. No offshore accounts, no fancy lawyers, no 7-year wait, just rules that already exist, most people have never heard of. And that cost families thousands of pounds every year through ignorance alone. We are going to cover exactly how the normal expenditure out of income exemption works, why business property relief could wipe out the tax on an entire company, and how a life insurance policy written in trust keeps a payout completely outside your estate. These are not workarounds. They are written into the Inheritance Tax Act 1984, and HMRC enforces them exactly as written. But before we get into the strategies, you need to understand why inheritance tax has become a problem for people who never expected it to be their problem. The standard inheritance tax rate in the United Kingdom is 40%, applied to everything in your estate above the nil-rate band, which sits at £325,000. That figure has not moved since 2009. Under the Autumn Budget 2024, it stays frozen until at least 2030. Meanwhile, property prices have continued climbing. The average London property now sells for over £500,000, and a house bought in southeast England 30 years ago for £120,000 might be worth £800,000 today, before savings or pensions are included. HMRC reported that £7.1 billion was collected in inheritance tax receipts in the 2024 to 2025 fiscal year. 1 in 25 estates now pays inheritance tax, compared to 1 in 35 just a decade ago. That shift is not happening because families are suddenly richer. It is happening because the threshold is standing still while everything else moves. A couple in their 70s who bought a home in the West Midlands in 1991 and never thought of themselves as wealthy could leave their children facing a bill calculated at 40% on a significant portion of an estate they built over a lifetime. Families in that position are not who inheritance tax was designed for, but they are the ones paying it, which is exactly why the 3 strategies in this video matter, because they are not designed for billionaires. They are designed for anyone who understands the rules well enough to use them. The first strategy is called normal expenditure out of income, written into Section 21 of the Inheritance Tax Act 1984. If you earn more each month than you need to live comfortably, you can gift that surplus income to someone else. And it is immediately exempt from inheritance tax. No 7-year wait, no taper relief, no trust structure required. The money leaves your estate the moment you give it. The rules are specific. The gifts must come from income, not savings or capital. They must be regular, following a consistent pattern, not random one-off transfers. And they must not affect your standard of living. If HMRC can show that your gifting forced you to dip into capital to cover your own bills, the exemption disappears, and that money gets pulled straight back into your estate. When it is done properly, the savings are real. Someone earning £120,000 a year who needs £70,000 to live well has a £50,000 surplus, gifted at £2,000 a month to a child or grandchild. That removes £240,000 from the estate over 10 years, a £96,000 saving at the 40% rate on money that was never going to be spent on the person giving it away. There are also smaller exemptions that stack on top of this. Every person in the UK has an annual exemption of £3,000 per year that is immediately outside the estate the moment it is given, with the prior year's unused allowance carrying forward to £6,000. A small gifts exemption covers up to £250 per person to any number of recipients per tax year. Parents giving a wedding gift can give £5,000 tax-free, grandparents £2,500, and anyone else £1,000, all immediately exempt. None of this requires a solicitor. What it requires is documentation. HMRC expects records, and the standard tool for evidencing regular gifts is the IHTA 403 schedule, a form used when applying for probate that logs all gifts made in the 7 years before death. A simple annual record of what you gave, when you gave it, and what your income and outgoings look like that year is enough. The single biggest mistake with this strategy is the absence of those records. The gifts are legal. The exemption is valid. But without documentation, there is no defense. The second strategy is business property relief, known as BPR, written into sections 103 to 114 of the Inheritance Tax Act 1984. At its most powerful, it reduces the inheritance tax on qualifying business assets by 100%. A business worth £2 million could pass to the next generation with zero inheritance tax, provided the owner has held it for at least 2 years, and the business meets the qualifying criteria. The relief applies to sole trader businesses, shares in unlisted companies, and shares held on the AIM market, the alternative investment market, for more than 2 years. Businesses that are mainly investment in nature do not qualify. A property investment company collecting rental income is not a trading business in the eyes of HMRC. Neither is a company that has accumulated large cash reserves without a clear trading purpose for that cash. If more than 50% of a company's activities are investment rather than trading, the relief can be denied or reduced. The change coming in April 2026 makes this more pressing. The Autumn Budget 2024 announced that from April 2026, 100% BPR will apply only to the first £1 million of qualifying business and agricultural assets. Anything above that level will receive 50% relief instead. For a business worth £5 million, that is the difference between zero inheritance tax and a bill approaching £1,600,000. Anyone holding a qualifying business worth more than £1 million needs to be reviewing their estate structure before April 2026 arrives. There is one trap worth naming directly. Some business owners assume they can build a qualifying business, accumulate BPR protected value, sell the business, and pass the cash on instead. That logic does not hold. The moment the business is sold, the protection disappears. Cash does not qualify for business property relief. A £2 million business attracting 100% BPR becomes a £2 million cash sum attracting 40% inheritance tax the moment that sale completes. The asset has to pass on, not the proceeds. The third strategy works differently from the first two. Normal expenditure, out of income and business property relief both reduce the taxable estate. Life insurance written in trust does not reduce the estate. It puts money directly into your family's hands outside the estate entirely, bypassing inheritance tax and probate at the same time. Here is the problem it solves. A person dies with an estate worth £600,000. The nil-rate band covers £325,000. The remaining £275,000 is taxed at 40%, producing a bill of £110,000. Before that bill is paid, the estate cannot be distributed. Probate can take months, sometimes more than a year, and during that period the family may have to sell assets under pressure to raise the cash. A life insurance policy written in trust solves this directly. The policy sits outside the estate. When the policyholder dies, the payout goes to the named beneficiaries, not through probate, not subject to inheritance tax, arriving within weeks rather than months. The practical setup looks like this. Someone with an estate of £500,000 and an expected tax liability of around £70,000 sets up a whole-of-life policy for £100,000 written in trust with their children as beneficiaries. When they die, the money reaches the children directly. The tax bill gets paid without any forced sale, without any borrowing, and without waiting on a probate timeline. The strategy only works if the policy is set up correctly from the start. A life insurance policy not written in trust falls back into the estate and gets taxed, which entirely defeats the point. Missing premium payments can invalidate the policy. Choosing a payout level that does not match the actual expected tax liability leaves the family short. And failing to update trust beneficiaries after major life changes, a divorce, a death in the family, the birth of grandchildren, creates legal complications that take time and cost to resolve. The real purpose here is not avoiding tax in a technical sense. It is giving your family liquidity and control at the moment they are under the most pressure, without having to sell a property below market value or take on debt against a fixed legal deadline. Every strategy in this video is legal. Every one of them is used by families across the UK right now to manage real inheritance tax exposure, and every one of them can fail if it is not handled properly. With normal expenditure, out of income, the three failure points are irregular gifting, gifts made from capital rather than income, and missing records. With business property relief, the risks are the investment activity trap, the 2-year ownership requirement, and the April 2026 threshold change that will catch anyone who has not reviewed their structure in time. With life insurance in trust, the problems are failing to write the policy in trust at outset, underinsuring relative to the actual projected tax bill, and neglecting to update beneficiary nominations after life events. The pattern across all three is the same. The rules work, and the problem is always implementation. Inheritance tax collected £7.1 billion last year alone. 1 in 25 estates is now caught by it. The nil-rate band has not moved in 16 years and will not move until at least 2030. The combination of frozen thresholds and rising asset values means more families every year are walking into a bill they never planned for on wealth they spent a lifetime building. The three strategies covered here, normal expenditure out of income, business property relief, and life insurance written in trust, do not require offshore structures or specialist firms. They require understanding what the Inheritance Tax Act 1984 actually says and building a plan that uses those rules the way they were designed to be used. The difference between a family that pays a 6-figure tax bill and one that does not is rarely the size of the estate. It is almost always the planning. If this video gave you something useful, share it with someone who needs to hear it. Subscribe if you want more content like this. And if you want to go deeper on any of these three strategies, the next video is already there waiting.